And good afternoon, everybody. I am Michael Filighera, and I am with LogicalSignals.com and also TradersHelpingTraders.com. And I am here to make my presentation today, which I've titled, You Are Your Own Guru. And some of the things that I've heard listening into the other presenters, both yesterday and today, I ended up actually on mute, but standing saying, yes, 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 I agree. And what many of the other presenters have given us is some very valuable information in terms of when we're using our indicators. There is a tendency for many traders to over accessorize a chart, so to speak. They put on so many indicators that you're being spun around as to whether, what do I enter? Do I not enter? Do I get in? Do I get out? What is this indicator telling me? And I have run into more people that have come looking for information from me, and it always ends up being the same thing. And so what I tell them is that you need to choose which, if you're getting a new indicator and you're saying, oh, I think this could really work for me and I like the way the signals are given, then the first thing you need to do is to go in and learn everything you can about that indicator, so that as you apply it, you're doing it, number one, correctly, and you're picking up those signals in a correct fashion. Now, the other thing that I have found very interesting over time is that my own history in the markets go back to 1979, when I began trading here on the Pacific Options Exchange, and I was an options market maker. And I've also been an options market maker on the London traded options market, the European Options Exchange in Amsterdam, and also my first introduction into electronic trading was via the DTB, which is the German exchange. And what I have learned and picked up through all of that is that electronic trading has really switched many concepts, ideas, indicators. And so what I mean by all of this is that if we really look back at even going back 10 years or 5 years, what were stable indicators that no matter what happened, when you got that overbought or oversold reading via stochastic or via an RSI or via many of the indicators, it was almost a guarantee. Gee, I'm going to go ahead and if I'm overbought, I'm going to sell it because I should be able to make money on the trade. That ceased to happen. And I think part of why that has changed so dramatically is that all of the trading now is algorithmic. It's all computerized. So essentially what we've really done over the years is that we have gone totally electronic. So I have kind of summed it up this way. And how I would describe trading today is that it's totally electronic, totally anonymous. And earlier, as a floor trader, as a pit trader, we got everything from the crowd. How is the crowd reacting? And a lot of that, of course, is all based on human behavioral responses. So when describing trading today, the size of the crowd producing those behaviors has exponentially grown from a few hundred in the pits of the good old days to hundreds of millions that are trading around the globe 24 hours, 7 days a week, producing trillions of transactions, all coming in electronically, hitting the market, most of them buy orders, et cetera, et cetera. But here's something that has not changed. All of the human senses continue to become involved. And the difference is that the triggers for those human senses, sight, smell, touch, hearing, and taste, the triggers are flashing green and red numbers across several screens that you might be trading with. So the touch is your finger on the mouse. The hearing, this is a joke, is occasionally the loud outbursts coming from my mouth towards the flashing red and green numbers. And the taste is the acid in your stomach and acid reflux coming back up. So when all of these things come together, it does actually affect how you trade, what you're going to do. So Now that there was definitely a learning curve moving from a pit trader to an at home in my office, which I now consider retail. So basically, the edge that many of us felt as market makers or pit traders is totally gone. We're all retail now. Professional traders, they still exist, but they're on the same playing field as the rest of us. They sit at home behind a computer, several screens, and they're placing their orders based on what they see. So again, human behavioral reactions continue to happen, and they continue to play a big, big part in what's going on. So there are many parts of trading that have changed, but there are many that have remained exactly the same, because there's hundreds and hundreds of new indicators and trading algorithms, and that assist us in making good trading decisions. But I've seen screens that are so chock full of indicators that I can't actually see the chart. So how do you make a decision when the process is so crowded with what ifs? Because that's basically an indicator is set up with a what if statement. What if the market goes here? Boom, you flash that. What if the market does that? You flash this. So it's a lot of what if statements. But I'll tell you what has worked in the past many times is no longer valid today. And like I mentioned, overbought, oversold signals used to be a solid direction predictor. But today, a market can remain overbought or oversold for, to me, what feels like an eternity. I mean, it just never ends. And it's almost like somebody forgot to send the how to use instructions to algorithmic programmers. But what I have found is there are several tools that, when they are applied correctly, remain accurate in analyzing market movements. These tools have stood the test of time and have been used in all the market conditions and are able to forecast with accuracy periods of bull and bear markets. So one of those tools is R.N. Elliott's The Wave Principle, and the other is the work of Leonardo Fibonacci. And so the combination of Elliott's Wave Principle and the Fibonacci number sequences, that brings an additional layer of precision to technical analysis. And that hasn't changed over the years. Both Elliott and Fibonacci's work are woven intricately into all the markets where human interaction is found. So basically, what am I saying? That the law of nature, which is found throughout Fibonacci's work, it has been applied to Fibonacci retracements, extensions, time sequences, fractals, and much more. So really, to understand nature is to know the law. And because we're human beings, we're a part of nature. We are subject to that law. Whether you want to believe it or whether you don't, we are subject to that law. So now, what I want to start to begin with is to kind of go back, and the subject of my ebook, which is How to Be You Are Your Own Guru, is that I've gone back. I'm a fundamentalist in terms of that I believe in going back to the person who really designed the Elliott wave, and that's R.N. Elliott, and read his original work so that I can get a really firm understanding of how this all functions and where he was coming from when he did it. And that's how I apply it today. So I went back and I was rereading a lot of his original work, which was published in 1936, and then Nature's Law, which was published, I believe, in the 40s. And the combination of the two really has, some of it has changed. But if you step out of that, you calling something Elliott Wave Principle, but you're using your own additions, it's like, well, I count this wave differently and I do that and I do this. It's no longer the Elliott Wave Principle. It's the John Doe Principle. And that's okay. But I think if you're going to use Elliott, then you have to stick to the original rules and the guidelines. Some of them have changed a little bit, but that's just the nature of electronic trading versus behavioral input. So all that Elliott really does is measure human emotions in action And he found the way that to do that, where they're found to be very predictable, is within the equity markets that, or all basically any financial market where human interaction is involved. So even though we're all electronic right now, we are definitively still human, and we're programming it. We're human, we're pushing those buttons. So there's still that human interaction. You still can get that feeling of panic coming up within yourself. If you enter a trade and suddenly it just turns and goes against you and you're trying to figure out, and you hit your button 3 or 4 times and suddenly now you're short and now it's stopped and it's going back in the other direction. So you see your human emotion is in there trading. You're not the only one. If we consider how many people are sitting there trading the same market, you get the same reaction. So what is Elliott Wave and what really is it all about? And that's kind of where I want to start to talk about a little bit today, and how I then apply this to the markets combined with Fibonacci. And basically in Elliott, there are 4 or 5 rules, and there are about 3 of those rules you just don't break. And so if you learn those and you understand that, to begin with, Elliott Wave principle, they are building blocks. So the basic premise is that the market moves in impulse waves, which consist of 5 waves. Wave 1, wave 2, wave 3, 4, and 5. Wave 2 corrects wave 1, wave 4 corrects wave 3. Wave 5 then completes that initial movement and sets the stage for what we would call a counter trend move, because it'll be a correction. And that comes in the form of 3 waves. And as you learn a little bit more, you start to learn to identify where these waves are. And because they're building blocks, the first complete movement, so that 1, 2, 3, 4, 5, and then an ABC, becomes the first and second waves of 1 degree higher. So if you're counting on a very, very small degree, which would be like a minute degree, which you're going to get if you're in trading on a 1 minute, a 2 minute, or a 5 minute screen, they're very, very small, but nonetheless, still very apparent. You still can see these wonderful rallies up in 5 waves, and then the declines in 3 waves, and then another rally in 5 waves. No, you can't really see it there, but they still exist, and they're building blocks. So if I'm counting on a minute and I get 5 up, that's going to be wave 1 of the next degree higher, which would be minor. And when I get 5 waves up in that, it's the next degree higher. It's going to move up to the intermediate level. So let me just start by, I always start my analysis by going to the chart where I can get the most information, the largest picture. Right now, and I'm using the S&P. Actually, if I go over to the SPX, it's going to give me a whole lot more. And here's the SPX. Now, this goes all the way back to 1932, which was the bottom of the crash of 29. That's where it actually bottomed. And so you can start your count from there to really figure out, where are we in the whole scheme of this long-term bull market? And what do all these mean? But you can identify the waves. That's a 5 wave, that's a 3. Then we get a very detailed run all the way up to the next group in the 70s of a corrective phase. That wave ended there, and this was all the correction. Then we began another bull phase. That's actually the crash of 87 right there. And I don't mean to make it that large because you can't really see it. And I apologize for that. So we'll zip it down. And now we're really back up, and you can see the same thing. You can see how the market, this was the crash of 09, 08, 09, and it really was a crash. That we came down in We went up in 5, we came, excuse me, we went up in a corrective move, and then we came down in 5, which was the C wave. But nonetheless, this was an A, a B, and a 1, 2, 3, 4, 5 C. So you learn the rules, you learn what goes on, and then you're able to identify. And then we build our pictures to where we stand right here. And I'm going to go back over to the ES because that's the one that I actually have labeled. And yeah, here we go. And now you can see, because I'm going to just go to a shorter term monthly chart, and these are primary levels. So let me go over where the levels are, the degrees. I normally don't go much higher than a super cycle degree, and that's not included here other than the very, very large picture. So what we have is a cycle degree fourth wave, and that's what ended at the bottoms of 2009. And then from there, we're starting in a cycle fifth wave. So on a cycle degree, it's going to have 5 waves of primary degree, which on this chart are labeled in green. And within each one of these primary degree advances, there are going to be 5 waves of intermediate degree. And you're going to see those labeled 1, 2, 3, 4, and 5. Then coming down within that intermediate level, there are 5 waves of minor degree. So within each one of these, 1, 3, and 5 are 5 waves of minor degree. And then within the 4, it's 3 waves of minor degree. Corrections are 3, impulse waves are 5. So, and impulse waves are 1, 3, and 5 with 2 correcting 1, 4 correcting 3. So now we're starting to build a picture of where are we. So I continue on and realize that the high that we got in 2020 was a primary degree third wave. And what we fell, and it was it only took 3 weeks, but we put in a primary fourth wave correction. So what does that tell me? It tells me that from that level, March of 2020, we are in a final primary fifth wave up, which will then complete a cycle wave 5, right? Remember, cycle level, it's an advance. We have 5 waves of primary degree. We're in that fifth wave. Now I'm going to start to go down and get inside this fifth wave. And there's the 4. Well, sort of. Let me go to the weekly. Okay. So there's the 4. And now we can start to see the individual breakdown. The launch off of that took everybody by surprise because we were in a pandemic. There was nothing that really told us, that's all behind us, just buy. But nonetheless, that's exactly what the market told us it was going to do. So here we have intermediate wave 1, because now remember, I'm counting a primary degree. Within that are going to be 5 waves, advancing waves of intermediate degree. And then inside those, they break down into minor degree. So here we have intermediate 1, intermediate 2, and believe it or not, now I'm going to go down one more, see if we can't catch this now on the daily. There's 1, 2, and then 1, 2, 3, which was a huge extension wave. Now we're in May of this year, a 3 and a 4. And now we're in minor wave 5 off of that level. And I'm going to come down to the 4-hour chart. So you're going to see how these are all building blocks. And then we have 1, 2, 3, 4, 5. And I'm going to put it down to the hourly, and we should be up to date. And now we're right here. And you can see now that is labeled the end of intermediate wave 3. And so now this is just recent because we just finished this yesterday. So what we reached here was, okay, now we're going to put in an intermediate degree fourth wave correction. What is that going to consist of? An ABC down. Once we get in there, waves A and C are counter trend. Wave B will be in the direction of the trend, but actually counter trend from the corrective position. So it's going to go up versus the other two going down. So what we have wave A and wave B, and then wave C subdivides very cleanly, very nicely. And that produced, here was our little trip and fall off of the news. Oh, the Delta variant is really going to get worse, and it's the end of the world, et cetera, et cetera. And the market really fell for it. But if you did your count and you realized what we were doing, you now can add Fibonacci retracement levels to get an idea of how far can this drop? What should I be expecting? Now, that's the point I wanted to get us to. Once we have developed where we are and what we're doing, then we're going to start looking at Fibonacci retracements or extensions to help us determine how far can the next wave go? What should I be expecting when that's happening? So essentially what I'm really kind of describing here is one way to take a lot of the guesswork out, one way of then using indicators that are available to you that have stood the test of time, that like so many, in fact, I really liked what Jake was saying in the previous presentation on he doesn't follow fundamentals. And a lot of people are like, what? What do you mean? That's how we measure the economy. And it's like, well, Elliott Wave doesn't really take into consideration any fundamentals either. Like when we're sitting here and I'm saying, oh, we're really going to do an intermediate fourth wave correction, you know, people are going to say, well, why? What? I think we're going to still build on the rally. It's like, well, yeah, but we need to correct first. Oh, but why? I have no idea. I don't know. I can just tell you what the wave count is telling me. And then I can wrap Fibonacci retracements or extensions around it to give me indications of how far human emotions are going to drive it. So, and when you're thinking of crowd behavior, I don't know how many of you ever really witnessed a trading floor or been on a trading floor, but crowd behavior can absolutely eat you alive. And you can make a quick choice to either not become a part of the panic, which sometimes is very, very difficult to do, or you fall prey to it. And if you're able to stand in that chaos, same thing here, if you're able to be within the chaos that you're watching in front of you on a screen without being enveloped by it, you're going to be able to pick out the opportunities. You're going to be able to go in and, oh, I'll take that. Oh, I'll sell there. Oh, I'll buy there. And usually become a winner. Now, because when a market is trending, I don't care what direction it's trending, you're going to have different indicators. Now, what I'm also presenting is that I basically only use three: Elliott Wave, Fibonacci, so it's a combination of those two. But the one that I really trust and I work with often, every day, are the moving averages. And the moving averages is I'm going to leave them right there and you can see. And the ones that I use are a 4, an 8, a 20, a 50, and a 200. I do have a 100 on here, but it's just kind of there. I don't necessarily use it as strong as I use the others because there's too many that don't use a 100. And these moving averages, and when you learn how they react, how they move, what they do, and when are they in alignment, and when are they telling me it's going to get choppy, they will. But you have to really learn about it. So again, it's taking the time to learn about each of these indicators that you're going to choose to use. Now, I'm going to tell you, let me just go over here. I'll tell you, look at that. And they're all sub-menus. If I can get over there. I got alpha, we've got bearish only, we've got, here you've got some of the better ones, downside gap 3 methods, Tusky gap, evening doji stars, falling 3 methods. That's a good one. You can use that, but learn it. Learn how it works and how to employ it on your chart and into your trading. Bullish and bearish candle pattern, bullish only, candlestick patterns, crossovers, cycle studies, daily studies, David Elliott's studies, John Carter's studies, which are really kind of fun sometimes. But I'll tell you one that really works: the scalpel alert and the squeeze. The squeeze, they do work, but learn about them, learn how they function. Go watch John Carter's uh, webinars or videos on how to use it. Then you can apply it. John Eller, also good. And a lot of his stuff. In fact, Doc Severinsen yesterday recommended some of John Eller's work. But you have to learn about them. You have to employ them correctly, not just kind of pick it up and toss it on and go like, "Well, that doesn't work. This guy's a fool." No, it's taking the time to learn before you put it on there and trade with it. That's kind of the message underneath. You can be your own guru. Don't rely on somebody else on what you personally do. If you're willing to put in the time to educate yourself and to better your own trading. So these are important things. And Marina Villatoro yesterday, same thing. She uses one simple, the MACD underneath her charts, and she trusts it. Why? Because she's taken the time to learn about it. She's taken the time to watch what it's doing to produce the divergence, and what is the market doing? And then to see, okay, what happens as this goes along? And that's how you build your trust. Get there and learn how to use it, and then go with it. And then you've got something, because otherwise you've got choices that just don't quit. I mean, here we got lower studies other, and they go A all the way down to Z. And I'm telling you, they just go. You can just see there are hundreds. So it can become very confusing. So if you're watching somebody through all of our presentations here and you see something, hey, I like that, or that might work for me, then you go and you find out all there is to know about it. And you maybe even the presenter is offering some form of coaching, and then you can go and get that, so that you're working with the person who's kind of mastered it and figure out all the ins and outs of that particular one. So if you're willing to invest in your own trading, whether you're making a career change, whether you really do want to just become this is your sole source of income, well, I love the idea. I think it's great, and it's very possible to do. But learn everything you can possibly do to learn. I mean, we've heard things today that people make decisions because, like Jake before, and I admire Jake Bernstein. I have known him for years, and I've been on shows with him before. He is a master. He has taken all the time, and his career spells it out. And as he said, he wrote 4 or 5 books on day trading, but he doesn't day trade anymore because the changes on how things are done are not in alignment with how he wants to day trade. And I think that's fine. So you can make that decision. But what I've attempted to do is to go back to what does continue to work, even in day trading. What does continue to work? So, and I have found it's basically Elliott and Fibonacci and the moving averages. So that's all I'm going to put on my chart. I don't want it all cluttered up. So, I mean, on my trading screens, I do have additional things, but that's on my other trading screens, which are right here. Let's see if I can pull this up. Okay, these are one of my trading screens. And you can see here I have value area high, I have point of control, and I've got some other signals which I need to turn off. There, okay, that's good. So I have the value area high, the point of control. Here are my moving averages. And then here is, where's VWAP? Is not even on this chart. It's got to be here somewhere. Oh, right there. I have VWAP, my moving averages in the value area low. And then I do have, I like the choppiness index, but that's just for day trading. And quick day trading, like on a 5, a 2, and a 1 minute chart. And then I use a stochastic, and that's what I use instead of a MACD. They're really very, very similar, and they will start to show divergence, and you have to trust that divergence versus what's actually happening in the market. because sometimes the divergence will show and you're like, well, they're still buying it. It's like, well, have confidence. They usually will catch up with one another. So when you're trading, I use my moving averages. And here, just open this up a little bit so we can get a little bit cleaner pictures. And I'll do it one more time, because now you're looking to catch the moves. You're looking to now combine this momentum and a stochastic indicator with what's the market actually doing. Well, now when I'm using my moving averages, one of the basic premises is that you see how right now on the 5-minute chart, this is the 200. This is the 50. Nope, that's the 100. This is the 50. This is the 20. And here's the 8 and the 4. The 8 and the 4 are basically sitting sideways, but they're kind of, now this one's trying to hook back up after hooking down. But these are kind of getting flat, which is telling you that the market isn't really going to go anywhere. But what I do is, like, now that it's breaking above this, it's kind of letting me know that maybe it'll continue. So you would take a stab and maybe you buy it. And you figure where your high is going to be, where you think it's going to, where you think it's going to go. The pattern in progress kind of tells me, it could end a lot lower. And so maybe you're just looking at a possibility of, this is an A, we're going to get a B, and then we're going to get a C wave down, or this is 1, we're going to get a 2, and we're going to get a larger wave down. So you would, first of all, run some Fibonacci's, retracements, and now you can see it. Well, it's gotten above 382. Well, that's pretty good. So where are my next levels? 78, and then 14,780, 81. Well, now you've got targets. Okay, where's your stop going to be? Right back there. If I got in here, I'm moving my stop up. Now, my stop is the 4. And you can see how your trade now progresses. And you can do it with, if you understand moving averages, and you understand how they function and how they will track, when everything is in alignment, because this one's edging back to being in alignment, and here's the 1 minute. So those are my trading charts, a 1 minute, a 2 minute, and a 5 minute. And that's what I'll do. I try to follow it. Now, let me be honest. This morning, it was not easy, because one of the things that you're looking for is are my NASDAQ 1 minute, 2 minute, and 5 minute charts in sync? Then are my markets in sync? In other words, we're all buying. So they're buying the broader market, which includes the Dow, which includes the S&P. So they're buying the Dow, they're buying the S&P, they're buying the Russell, and they're buying the NASDAQ. Boy, that's the trifecta. And you know, our upside move is back in gear. So by using Fibonacci retracements, you're now look, it's broken above 618. If it goes up a little bit higher, I'm going to put my stop right there, because it could stop and just turn back around. And I do want to protect my profit. Why not? This is actually the S&P. I'm not sure how that ended up there. So let me go over, put the NASDAQ back up there. And now you're going to see the rest of it. See, now it's moving up here. So you're now walking your trade up and not taking your profit too much. Or maybe you entered with 2 contracts and you're getting out of 1, and now you're going to let 1 just keep going. Now, mind you, right now, it's not moving at breakneck speed. So this morning, it was kind of moving at breakneck speed. And that made it very difficult. And the fact that the markets were not in sync with one another. And here's my measurement. That's the tick on the NASDAQ, the tick on the Russell, and there should be one more, not sure where it went. And then there's just the TICK, which is of the broader market. Let me see if I can put that on there because I like to have it. No, that's not what I wanted. Why did it do that? I'm over here. Can we do that again? Yes. T-I-C-K. Enter. Okay, that puts it up there. So what this is actually telling you, being that it's green, 450 issues within the broader market, which has, I think, over 1,600 issues, are being purchased. And the NASDAQ, well, they had a small sell hit the floor, but now they're moving it back higher. They're buying it. The Russell, 180 issues within the 2,000 are being purchased. So what's affecting our trade? That. And now you can see why. But remember, you put a stop there. So you're not going to sit through and give back everything you just made. You're on to the next trade. And the next trade, possibly, when it started to break below these levels, was a sell. Maybe that sell is just going to be a scalp because the market moved a little bit too far away from its four moving average, 4 period moving average. And this is the 8 period moving average. But now, do you see how it bounces? It bounces around there, and now they're going to buy it back up. And again, you can just see with what intensity. If this suddenly turns to 55 or 60 or 65, oh, there's only 100 issues on the NASDAQ 100. So it's not compiled on the basis of the composite, NASDAQ composite. It's based on the NASDAQ 100. So when you're seeing 65, 70, that's pretty much they're buying all of them. And so it's really you'll see this market will just move. And vice versa, if they sell it, you're going to see it go down. These are the indicators that I use. They're very important and they're very dependable. This I would take off my chart. I'm not sure. I use Thinkorswim actually on a different computer. So on this computer, it shows up with all of the volumes and open interest. I think it gets in the way, so I take it off. And let me see if I can do that. I might not do it. Stochastic open interest. There you have it. And say, okay. And it didn't, so it's volume. In any case, moving along, I find that also when we accurately, and again, here's another thing that I find to be very important. Your LE account, which you're using every day, and you're trading with intraday, is fluid. So you must be able to make changes to it that don't disrupt the overall nature of what's happening, but they may straighten out where it's going to end or where it's going to end if it's moving higher. And what I tend to do now, if I'm feeling that, okay, we're now in an intermediate wave 5, where do I think that intermediate wave 5 can get to? So let's add additional layers. And that's what I call them. We're adding layers. And I need to go back out to my weekly chart because I need to catch this. So now we're talking about the relationships, the Fibonacci relationships between waves. And this is where the beauty of the combination of the two has really benefited me, because you can run extensions from here, which is going to be, so what I want to do, I need to compare wave 5, which I think is now in progress. Well, what waves is wave 5 related to? It's going to be related to wave 1, but the bigger choice is going to be it's related to wave 2. So I need to now draw between, boy, that's tough to follow. Let me see if I can catch this on the daily because I can't really see anything up there at the top. I can, yay. So we start by putting that there. We run that to the top of 3, which is that 43.8450. and then we're running it down to the bottom of 4, which was 4209, we'll call it. And I'm going to take this back down so I can see that low. Nope. So let me just make a quick adjustment for accuracy purposes. And this is what you can do on Thinkorswim anyway. So this low was actually 42.24. So we're going to make that adjustment there. The middle point was, that's actually, where do I have it? 91, and it was 43.8450. Let me make that one. And the beginning point, I think, is okay. So let's hit okay on that. It makes its adjustments, and you can see adjust it that way. But you can't even see the first minimal, right? So we're trying to figure out, where can I find the top of wave 5? Let me go back out to that daily. There's your first one. And now I'm going to slip back down to the hourly so I can show it more cleanly. And I'm just going to pull this chart down. As a minimum, wave 5 needs to take out that high at 43.8450. That would be as a minimum. But more importantly, as it gets there, I want to be able to count the structure. I'm looking for 5 waves of minor degree. I'm in the third. The third is subdivided. So maybe the third should get up here. And we'll continue to add layers to this as they present themselves. So right now, once I get a top to wave 3 and a bottom at wave 4, I now can put where I think the minor wave 5 is going to go. And you're going to start to get overlap in here. I can put additional levels on as they present themselves. Right now, this thing projects. And I'll tell you what the most common for a wave 5 as it's related to wave 3 would be that it is 0.618 times the length of that third wave. And that's where that comes in. Now, my first guess would be like, no way is this S&P going to get itself up to just below 5,000 when it can't really even get itself back above this 43.84. Stranger things have happened. And if you follow me on any of my video casts, you know I say that all the time. I have learned that this market today in 2021 will throw you more curveballs than you can ever hope for. And one of them being like, they will exceed your wildest expectations. So what's it going to take to get even up here above 4,500 period when we haven't even broken 44? How are we going to get above 4,400? Well, what do we got coming up? They're expecting some of these big tech companies to blow the doors off. Well, what could that possibly do? Again, I don't go on fundamentals, but I know what's sitting out there. And right now, this is pretty strong. So I think the third wave is subdividing. And this is 1 of 3, 2 of 3. We're in a 3 of 3 now. It should be picking up the speed, but it may take until tomorrow because we're already up 56. Yesterday, we were up 83, but the day before, we were down that same amount. So let me just throw some other factors in here that I wanted to show. One, which is actually more apparent. Well, there was this one, which I think was, which is you can barely see it. But this decline, if you remember, that was, here it is. This was the PPI figure from last week. They hated it. They dropped the market. We opened, and look what they did. I'm sorry, but PPI, who cares? Boom. So that's what I'm saying about, a lot of our indicators for the market, producer price index, consumer price index, actually it was the CPI, and other factors. Well, it's just not even going to do it. But then the market ran up, and at that point ran to a new high. at 83.75. Then the market just absolutely rejected that. And this was the follow through that's like, oh, maybe we should be paying attention to those inflation figures, because then it started to bounce out and we started to see it in other places and how it was going to hit. But then we get to a low, and what happens? No, inflation, smation, who cares? Boom, 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 and they rally it back up. The market again rejects it. Then we start on a little bit larger of a correction. But again, knowing that if this ended what I have charted, at first I just left the 5 there because I could count the 5 up, and I just left the 5 there. And it may have even been this 5 because I thought, oh, I got to see what the market wants to do, what the market is telling me. And then the very next day, it went up and made another slight new high by 75 cents. And that was just a real quick flow over. And then it started to go down. And now I was more convinced that's the 3. And I got an A and a B, and now we're off to the races in the C wave. And understanding Elliott tells you right off the bat, C waves are always 5 waves, always. So if you're looking for a C wave and you're looking for it to unfold, it's going to be a 5 wave structure. Well, I got the first one down, but I thought, this is not done. And I didn't like the way it came off. So I thought that could be a C wave. And I even mentioned it. I said, well, what we'll look for from here is this thing to run and not stop. So in other words, if this was the ABC totally for an intermediate degree, could be, but number one, it would display intense underlying pressure to buy. So it's almost like a coil. Some of it was released. Coil, coil, coil. Some of it was released. And then it took all of this coil pressure, big. And I think it was Doc Severin talked about that as well. And it's true. You can measure it and you can see it. And the market's reaction is virtually the same. This was yesterday. We had negative, and they came in like they were going to start to sell it, and that would have left open the path for this thing to drop below 4,200 and on down towards 4,100. No. Boom. The market told us exactly what it wanted to do. It just rallied and rallied and rallied. So when you get those messages from the market, pay attention to them. Something else I always talk about, you must allow the market to tell you. I can't tell you. Elliott can give you a hint of what you should be expecting, but it is not putting a stake in the ground and saying, no, market cannot go higher. I say so. This is my count. I say so. Because remember, I told you, your count is going to be fluid. But here's the important things, folks. Using Elliott is very important because it really has stood the test of time. And so has Fibonacci. Fibonacci came up with his sequences, number sequences, in the 12th century. So it has served the test of time for 9 centuries. It is found all over nature, including us. If you read my introduction to in the ebook, it tells you, look at your human body. I mean, Fibonacci numbers, right? 1, 1, 2, 3, 5. Now look at the human body. There are 5 senses. There are 5 out of our head. We have 5. We have the nose, we have the eyes, we have the ears. So they're just, and it just goes on. Out of our torso, we have 2 arms. Out of each arm, you have 5 fingers. Then out of the torso, we have 2 legs. And within those 2 legs, we have 3 joints. Then again, down at the bottom, we have 5 toes. So nature reproduces itself over and over and over again. I'm sure you've all heard it. The fractal nature of cauliflower, the fractal nature of many, many, many plants. You know, succulents. Look at them. They repeat. The pattern repeats. The pattern repeats. The pattern repeats. That's nature. That's the law of nature. So why would we think that we as human beings are going to be different? We repeat the same patterns in our growth, in our human growth, our bodies, and also through our emotions. That's what makes Elliott work, because it's human interaction, and you can measure that, and it measures in recognizable patterns. This is what and I'll tell you what, you can be skeptic, and therefore this would not be for you. But if you're willing to accept that we all are a part of nature, and there are the laws of nature, nature's law, laws of nature, laws of the universe, whatever you want to call it, they're real, and they are applicable to all of us. It just is a fact. And so when you can accept the Elliott wave, then you basically, if you're going to accept the law of nature, is to know it. So to know the law is to accept the law. Same thing. We live under a rule of law in our country, in our cities. Certain things you can't do, and if you do them, you're going to be, most of the time, you're going to be held accountable. And many times you're held accountable by removing you from the general population and putting you somewhere where you can think about what you did, right? Prison, lockup, whatever. And so I really just want to go back to, it is not that simple, because there is a learning curve, but when applied, it is going to keep you out of trouble. Now, when you want to break this down and you want to come in and you want to start day trading, and this is how I'm going to wrap up here today. When you're day trading, you must come in and you must understand the product that you're going to choose to day trade. The S&P moves very nicely, but does not move at the fast clip that the NASDAQ does. The NASDAQ will swing you around silly in a matter of a minute. These are 1 minute bars. So in 1, 2, 3, 4, 5 minutes, they took the NASDAQ from 14,772, we'll call it, to 14,785. Okay, so that's $13 at $20 a point. So you can do the math. And if you're doing one contract, it'd be equal to that. If you're doing 2 contracts, double it. If you're doing 3 contracts because you want to really get the move, you can triple it. And now you can see how quickly a move, even with 2 contracts, can really just turn and kick you out. So there's things you need to learn. When you're coming into day trade, you, one, have an idea of what you think the market's going to do on that particular morning. And that's your analysis. That's provided by Elliott. And because they're building blocks, I can take what I found out on the monthly chart and I can just work it down to my 1 minute, 2 minute, and 3 minute chart. It's the same patterns. They repeat. They're building blocks. They repeat. So right now I'm in sub-minuet. That's in some minute, they're very small. But here on my 1 minute chart, they're very big. So it's all relative. Now we're trading and we're just trying to go in and grab. What's your goal? Do you have a daily goal? What do you want to trade? What do you want to make each day? So you got to get your mindset correct as well. So what I try to do in my trade room, and also in just teaching, which again is kind of been my goal now. I'll just rephrase a couple of things. I enjoy teaching very, very much. I like sharing what I have found to work with others, and then watch them combine that with some things that they've already used, but they need to perfect them. So I like helping people to become better traders. I like helping new people so that they really can get an idea and also then be able to stand and do the trading with confidence, reach their goals with confidence. And there are methods that you can use. There are systems that you can buy into if you're looking for funding. Well, there are a lot of them, and you know that we've all talked about them here. Top Step Trader, One Up Trader, Lilu Trading, just to name some, and I know there's a whole lot more. And they're willing to, you pay a little bit into it and they give you an account that you then prove that you know how to trade and you know risk management and that you can consistently earn money. Then they're going to give you another account, a performance account or a live account, where they're saying, okay, you've got this amount of money, and it's usually in margin, not that it's the actual physical $50,000 or $100,000 that they're putting into an account. It's usually margin, and that's fine. So then as you make money, you keep 80%, you give 20%, or you keep 100% of the first X amount, and then you split it with them. That is very valuable information, and it's actually an excellent way for people that are coming in with, oh, I've only got $5,000 to dedicate to trading. How do I use that? It's possible, but understand, and Jake mentioned this just previous to me, your amount that you're going to need to successfully day trade is truly going to be upwards of $50,000 to $100,000, because the market can whip you around. But can I start with 5 or 10,000? Yes, you can, because now there are the mini contract and there's a micro contract. This one that is shown, it's the mini contract. It's $5 a tick, 4 ticks to the dollar here in the NASDAQ. So this thing will move in a minute from 83 to 87. That's $4. That's $200 on a one lot. So, and right now it's not really whipping around very, very much. So to kind of wrap it up, there are things that I believe that every day trader should know. Is it possible to day trade and earn a living? Yes. Not for everybody. Again, reflecting on what Jake presented previously, it's just, he doesn't day trade anymore. I think that's a fair decision. We each need to make that decision. But I do believe that it is possible to make substantial money day trading if you have the right tools, if you have the right strategy, if you have a trade plan, and you build your knowledge. I think it is very, very possible. Not every trade's going to be a great trade. Not every day is going to be easy to trade. But these are things that you must accept if you're going to step into the arena and give it a shot. And I'm going to kind of leave it if anybody has a question. I've got about a minute left. Oop, I stopped my share. I didn't mean to do that, David. Let me see if I can get that back. I think I can. There we are.
Oh.
So if anybody has any questions, otherwise, I am going to hand the reins back over to David. I thank you very much, David. Thank you, Anka.